Right now, while most people are sleeping, the market is already making decisions about your money. Futures are dropping, oil prices are rising, headlines are getting louder. And for beginners, this feels like chaos. But here's the truth. Moments like this are exactly where long-term wealth is built. And yes, even a banana-loving investor like Money Monkey knows that. What's up, everyone? Welcome back to Money Monkey, the only place where a monkey in the jungle, sitting at a wooden desk, surrounded by charts, cash, and a slightly outdated laptop, teaches you how to build real wealth. No hype, no guessing, no get rich tomorrow. Just simple strategies that actually work. Now today, we're talking about something that makes a lot of beginners nervous. Big political news, rising oil prices, falling markets. And the question everyone is asking right now is this the start of something bad? Money Monkey leans back, slowly peels a banana, and says, or is this the moment smart investors have been waiting for? Let's break this down in a simple way. After a major political speech from Donald Trump, markets reacted immediately. Futures dropped across the board. The S&P 500, the Dow Jones, the Nasdaq, all showing short-term weakness. At the same time, oil prices moved sharply higher, crossing the $100 level. Now, why does that matter? Because oil is like the fuel of the global economy. When oil becomes more expensive, transportation gets more expensive, production gets more expensive, shipping gets more expensive, and that cost gets passed on to everyone. That's inflation. And when inflation rises, central banks usually react carefully. They may delay lowering interest rates. They may keep financial conditions tighter. And markets don't like that uncertainty. So prices fall. But here's the part most beginners don't understand. Markets don't fall because the world is ending. Markets fall because expectations change. That's it. Money Monkey taps the desk and says, expectation down, price down. Expectation up, price up. Simple. Now let's zoom out. Because zooming out is what separates investors from gamblers. Over the past decades, markets have gone through wars, oil shocks, financial crises, pandemics, political conflicts. And yet, the long-term direction has always been up. Not in a straight line, but step by step, dip by dip, recovery by recovery. Now let's talk about what beginners usually do in moments like this. They see red numbers. They read scary headlines. They open their portfolio, and then they panic. Some sell everything. Some stop investing. Some wait until things calm down. Money Monkey laughs and says, that's like waiting for the jungle to be quiet before planting bananas. It's never quiet. There's always something happening. Always a crisis. Always a reason to wait. And people who keep waiting never start. So let's make this practical. Imagine two investors. Investor A waits for the perfect moment. Investor B invests every single month, no matter what. Now fast forward 20 years. Investor A is still waiting. Investor B owns a portfolio. Which one do you think wins? Exactly. Now let's go deeper into ETFs, because this is where things get really powerful. An ETF is basically a basket of many companies. Instead of betting on one company, you invest in hundreds, sometimes thousands. For example, an S&P 500 ETF gives you exposure to 500 of the biggest companies in the US. Companies like Apple, Microsoft, Amazon, and many more. So instead of trying to pick winners, you own the entire system. Money Monkey nods and says, don't chase bananas, own the whole banana farm. Now let's talk numbers again, because numbers remove emotion. Let's say you invest $300 per month. That's $600 per year. Over 25 years, that's $90,000 invested. Now assume an average return of 8%. After 25 years, your portfolio could be around $260,000 to $300,000. That means more than half of that money comes from growth, not from what you put in. That's compound interest. Money making money. And then that money making even more money. Now here's where it gets interesting. What happens if the market drops and you keep investing? You buy shares at lower prices, which increases your long-term return. This is called cost averaging, and is one of the most powerful strategies for beginners because it removes the need to time the market. You don't need to guess. You just stay consistent. Now let's connect this back to what's happening right now. Oil is rising. Markets are nervous. Uncertainty is high, and many investors are stepping back. But long-term investors, they are stepping in. Not aggressively, not blindly, but consistently, because they understand something very important. Short-term fear creates long-term discounts. Money Monkey leans forward and whispers, "This is where the future millionaires quietly buy." Now let's talk about risk, because this is important. Yes, markets can go lower. Yes, volatility can continue. Yes, headlines can get worse. But here's the key. Risk is not volatility. Risk is making emotional decisions. Selling at the bottom. Stopping your investments. Or never starting at all. That's real risk. So what should you actually do? Keep it simple. Step 1. Build a habit of investing monthly. Even if it's $50. Even if it's $100. Consistency matters more than size. Step 2. Focus on broad ETFs, not hype stocks, not trends, not next big thing, just the market. Step 3. Think long-term, not days, not weeks, years. Step 4. Ignore noise. News is designed to grab attention, not to build your wealth. And step 5. Be patient, because wealth takes time. Now let's talk about something most people don't want to hear. There will always be another crisis, another drop, another scary headline. And if your strategy depends on feeling safe, you will never invest enough. Money Monkey smiles and says, "If you wait for perfect, you get nothing." Now imagine this. 10 years from now, you look back at this moment. Markets were down, people were scared, and you kept investing. That's the difference. That's how wealth is built. Not in perfect conditions, but in uncertain ones. So here's the key takeaway. Markets go up. Markets go down. But disciplined investors move forward. Stay calm. Stay consistent. Stay invested. Money Monkey taps the desk, looks straight into the camera, and says, "You don't build wealth by reacting. You build wealth by staying." If you found this helpful, make sure you like the video and subscribe to the channel, because there are more videos waiting for you right here. Videos that will help you understand ETFs, build passive income, and grow your portfolio step by step. So don't click away just yet. Pick the next video on your screen and keep learning.